It's risk on heading into the final hours of Friday's session. Hello traders, this is Farwaz Akzala, market analyst for City Index. Today is the 24th of October. The risk on sentiment has been a key theme in the markets this week, and it's all to do with optimism about the upcoming US-China trade talks, which is happening in the week ahead. We've also had lots of earnings, and on the whole, they were really decent. And technology company earnings are coming up next week, but we do face a busy week from a macro point of view next week as well. Ahead of that, we had the CPI data earlier today coming in weaker than expected, 0.3% month over month on the headline front. The core number was 0.2%, again, weaker than expected. And this has cemented expectations that the Fed is going to cut interest rates next week. Now, speaking of the Fed, we have the FOMC meeting on Wednesday, I think it is. But we also have lots of other major central bank meetings as well in the week ahead. Now, the Fed is expected to cut rates by 25 basis points, and they could signal another rate cut for December, which is likely according to market pricing, because we've had delay in release of US data because of the ongoing government shutdown there. So there's no reason really for the Fed not to cut interest rates because of the lack of data. Other major central banks that will be in focus will start off with the Bank of Canada next week. A 25 basis point rate cut is expected there as well because of weakness in Canadian data. But we did have CPI coming in slightly ahead of expectations earlier this week, although I don't think that's going to be a game changer. Another central bank meeting is the Bank of Japan next week, and a rate hold is expected at this particular meeting, although a rate increase is potentially on the way for December. Let's see if there will be any indications of that in the central bank's meeting next week. The ECB, meanwhile, is expected to hold interest rates unchanged. Here, economic data has been quite decent, especially in places like Spain, where employment continues to rise. And inflation has also been falling in the Eurozone, which is no longer a major issue for the European Central Bank. So for all of those reasons, the central bank has turned neutral. So with the ECB being more neutral, the euro-dollar has been kind of moving sideways and holding its own above this area of support in the last several weeks. But this is because, we've seen a bit of a comeback by the US dollar. And if you look at the euro against other major currencies, it has still continued to outperform, especially against the Japanese yen, where the yen has been weakening across the board. And the euro-yen here is now pushing towards that 178 level, which it tested a couple of weeks ago, and it fell from there. But the part of this resistance on the euro-yen is clearly to the upside, having already broken the high from 2024, and it's continuing to make higher highs and higher lows. So keep an eye on this currency pair, because we do have the Bank of Japan meeting as well next week. And for as long as the Bank of Japan doesn't surprise the markets, we could well see some further gains in this currency pair. Following the weaker than expected CPI report, we saw a bullish breakout on the S&P 500. As you can see, it has taken out resistance trend of this continuation pattern, and it has broken to new highs. So it's clear blue skies really for the S&P 500 heading into a very busy week next week, where lots of central bank meetings are taking place, and more to the point, the US-China trade talks will be in focus, as well as some key technology company earnings as well to guide us. Ahead of all of that, the path of least resistance on the S&P 500 is clearly to the upside, given that we're trading at record highs. Previously, there was some resistance seen around the resistance trend of this continuation pattern, but we've taken that out now. So any rounded retest of that level from above is likely to provide support, should we see that at the start of next week at around 6,749 is the level to watch. Below that, we have the area of breakout, prior breakout, and the 21-day exponential moving average coming in at 66.70 to around 66.80 area. And then below that is this shaded green area of support, which will need to hold really to keep the bullish bias intact. So where do we go from here? Well, the run handles of 6,800 and 6,900 were the next key levels to watch for potential profit taking. We've hit the 6,800 level today. The next level is 6,900. But the big one is the 7,000 level on the S&P 500, because that is a major psychological level, and it comes in just ahead of just above the 161.8% Fibonacci extension of the last significant downswing that took place earlier this year. So we've already broken the 127.2% of that. I've deleted that from the chart, but the 161.8 extension of that move is still untested, which comes in at 6,980. So the next upside targets for the S&P 500 include 6,900, 6,918, and then that 7,000 area to watch in the week ahead. Can we get to all of those targets in the coming weeks is the key question. But also watch out for a possible false breakout scenario here, given the high risk that something might happen in the US-China trade talks. If those collapse, then we could potentially see a reversal in the market, but we'll cross that bridge if and when we get there. For the time being, the path of least resistance is clearly to the upside. It has been a rather volatile week for the precious metal. Gold fell quite sharply after hitting resistance at 4,380-ish, the shaded area here. And it broke below prior support at around 4,200, where it has remained below since then. But it has found some support around the 21-day exponential moving average and this bullish trend line that has been in place since the end of August. This area of prior breakout as well at around that 4,000 level comes in at precisely between 4,000 to 4,022. We tested that level earlier this week and we bounced from there. So this area is holding firm for the time being. And for as long as we now hold above this area, there is a possibility for gold to start another bullish run from here. But it does now face some resistance around this shaded region around the 4,200 area, or specifically between 4,186 to 4,220, marking the lows from these candles, daily candles. And so that's the most important short-term resistance area to watch moving forward. And if we can climb above this area in the coming days on a daily closing basis, ideally, I think that would be very bullish. And in which case, we could potentially pave the way for a fresh run to new highs and possibly that 5,000 level in the coming weeks. But first things first, we'll need to see gold break through this area, and then we'll take it from there. So there you have it. Those are the key levels to watch on gold. For more market updates and insights, make sure to check out the news and analysis section at cityindex.com. I'll see you in the next video. Take care.